Welcome to the Advisory Group's first quarter economic review for 2024. Let me start with some quick introductions. My name is Brent Beverly. I'm the president of the Advisory Group. Also joining me today is Manny Chinche, a senior wealth advisor at the Advisory Group. Now, both of us and my business partner of 40 years, Christian Lee, are certified financial planners, practitioners, and are wealth advisors at our Diamond Bar branch. So thank you for joining us. We like to say that knowledge is power. The more you know about what is going on, the more you know how things work, the more you're going to like what we do. One of our missions is to share with clients any knowledge that can help you make informed decisions. We believe, again, the more you know, the more you like what we do and how we do it. As a reminder, it's always important to review that there are 5 key areas for financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we always try to consider the impact of any recommendation we make on not just one, but all of these areas for our clients. In this workshop, we're primarily going to be focusing on investment planning. So to get us going, please allow me to bring up Mr. Chinche. Manny?
Thank you, Brent. Let's first take a look at the equity markets. Now, the first quarter of 2024 continued to reward investors who stayed the course and enjoyed strong returns in 2023 as the momentum of 2023's year-end rally took another step forward. As you can see from the charts on your screen, while the equity market movements were not in a straight line, they were upward for the quarter. Overall, both equity and bond markets performed well after the Federal Reserve confirmed that disinflationary trends were consistent and satisfactory enough for them to finally consider monetary easing begin this year. The S&P 500 experienced its best first quarter since pre-pandemic in 2019. All 3 major indexes had strong finishes, and both the S&P 500 and the Dow Jones Industrial Average closed at record levels for the first quarter. For the quarter, the S&P 500 returned over 10%, closing at 5,254, while the Dow Jones Industrial Average finished the quarter at 39,807, adding over 5%. The Fed did not raise the federal funds rates in the first quarter, and they remained in the target rate range of 5.25% to 5.5%. During the Fed's March meeting, it was also indicated that we could see several cuts in 2024. To date, we have not seen any rate cuts in 2024, and the recent inflation numbers could extend federal interest rate stagnation. Inflation pressure continued to be a concern as March's inflation results showed a rise of 3.5% from a year earlier. This was a slight increase from February, where the 12-month percent change in all items in the Consumer Price Index was up 3.2%. The rise caused concern that we may still not see an interest rate reduction from the Fed in the first half of 2024, and we might not experience the 3 potential rate cuts for 2024 that the Federal Reserve anticipated earlier in the year. The stock market responded unfavorably, no surprise, while yields climbed on U.S. government bonds. Now, there are 6 more scheduled Federal Reserve Committee meetings in 2024, and although it is currently anticipated that rates will go down at some point this year, the Fed remains committed to achieving the 2% inflation rate goal and intends to adjust rates accordingly should inflation pressures have a resurgence. Our belief at this point is higher for longer, but we do not control that. The Fed does. As you may be aware, bonds and interest rates move in opposite direction. When interest rates rise, existing bond prices tend to fall, and conversely, when interest rates decline, existing bond prices tend to rise. Currently, we still have an inverted yield curve. This means that short-term bonds are yielding more than longer-term bonds. As of March 28th, 5-year Treasury notes yielded 4.21%, 10-year notes yielded 4.2%, 20-year notes yielded 4.45%, and 30-year notes reached 4.34%. As of the end of the first quarter, this inverted yield curve has remained longer than the previous record of a 624-day inversion in 1978. So while many analysts consider inverted yield curves as a precursor to a recession, we have yet to see such an economic downturn. Now, we will continue to closely monitor how the Fed's movements and interest rates are affecting bond yields. With the Fed's anticipated interest rate cuts in 2024, this may narrow the opportunity to get lower risk, higher yielding bonds. Safety comes with a cost, and even though interest rates have risen, many major banks are still averaging low interest rates to savers. We like to phrase this as going broke safely. According to Barron's, the average bank money market rates on April 1st of this year were still only 0.6%, and the average 12-month CD rate was 1.95%. While they have increased over the past 12 months, savers are still seeing lower returns. And for anyone who is interested in exploring better interest rates, please contact our office. If the Fed delays cutting interest rates again, or possibly reducing the number of predicted cuts in 2024, this or any other major negative event could adversely affect equity markets. Uncertainty and confusion could also shake the strong investor confidence that is now prevalent. With many unknowns ahead, it is always possible to see a market correction in the near future. Most economists predict that should a market correction, which is defined as a decline of 10% or greater in the price of a security asset or financial market, happen, it will be a modest one. As the chart on your screen shows, since 1954, after a first quarter of more than 10% returns in the S&P 500, the second quarter was higher 9 out of 11 times. All of those years included pullbacks. What's a pullback? A temporary retreat of no more than 5 to 10% in the price of a stock, or corrections during the year. However, 10 out of those 11 years ended with positive returns with an average of 11%. Coincidentally, the average pullback during the year was also 11%. Please remember, as with all data, past performance does not indicate or guarantee future results. Along with caution, it is important to remember that markets often tend to go up over time. Even investing at all-time highs can be rewarding, as these graphs, compliments of JP Morgan Asset Management, help us to illustrate that markets often continue to go up after new highs. The global economy continued to have its share of uncertainty during this first quarter. This year, the U.S. is in the middle of a heated presidential race. There are also key races for the Senate and House of Representatives that could impact policy and tax law, leaving much up in the air. Uncertainty and unrest with geopolitical issues also are a key fear for equities, and we will continue to keep an eye on how they may affect the equity markets. Now, please, to finish the session, allow me to bring up Mr. Beverly. Brent?
Thank you, Manny. So although the first quarter of 2024 was positive for investors, equity investments should always be viewed with a long-term lens, and short-term movements are still always unpredictable. So now's a good time to review your investments and confirm that they're still congruent with your time horizon, your risk tolerance, and your goals. So regardless of what 2024 will bring, it's always prudent to watch your expenses and make smart money and investment decisions. We believe in proactive preparation, and our goal is to provide our clients with a solid financial strategy that is carefully designed to withstand any market movements. So a long-term strategy should always be the benchmark for smart investors. We would like to remind you of these 4 things that can help us approach your investments with discipline and focused direction. Your risk tolerance or risk appetite. By this we mean how much risk can you take, or better yet, how much can you afford to take? We want to look at your time horizon, or the amount of time you want to be invested in any situation, which can help you determine your entry and exit points. Your behavior. Market volatility is a part of the investment experience. This can create anxiety and stress when volatility occurs. Do you know how well you can emotionally endure the potential ups and downs of your investments? And finally, stay focused on your overall strategy. Don't get caught up in emotional investing. Are you looking for something that doesn't quite fit with your overall strategy? Perhaps the media is influencing you to make a rash or impulsive decision on your investments. So we're here to help you overcome that short-term fear or greed emotions that might distract you from your long-term approach to investing. We want your holdings to be consistent with your overall strategy. Panic, which we run into sometimes, can actually create more risk and potentially cause setbacks to your goals. We believe that long-term success comes from maintaining your overall strategy. Now, we're not the only ones who believe that. It might be a good time to remember the words of wisdom from the legendary investor Warren Buffett. And I quote here, "The most important quality for an investor is temperament, not intellect." So let's do a quick recap of this first quarter. Very healthy first quarter, but there are some things to remember. Inflation is still elevated and is a possible cause for concern. An inverted yield curve, as Manny talked about, remains, with short-term rates more attractive than long-term rates. The Fed is still indicating that we should see rate cuts this year in 2024. That said, there are several key factors that could bring a possible market correction this year. Volatility remains. Remember, a well-balanced portfolio should be designed to understand that volatility is always possible, if not probable. Okay? It's just part of the investing equation. Staying the course and maintaining the consistency of your well-devised, long-term focused plan has historically served investors well. Now is not a time to throw caution to the wind, nor is it time to try to time the markets. As investment professionals, we still like to be prepared. Recent history has shown us that anything can happen. So once again, proceeding with caution should still be the principal notion for investors. We help clients create well-drafted strategies and plans that are customized for their unique situation and goals. And then having that solid plan includes considering your time horizon, the tax implications, the liquidity needs, your risk tolerance, the overall personal objectives that you might have. Pretty complicated, but it's all important. We appreciate your focus on this. Here are some important disclosures that you should check out. Maybe pause your system and take a look at these. If you want to ask any questions or do any follow-up, here's how to contact the advisory group. Please reach out to us. We like to help people. We enjoy that process. Thank you for attending. That concludes today's presentation. Have a great day and a fantastic 2024.